The absurdity of the market's reaction to Nvidia's dividend. Apple and China, plus more conversations around inflation on this episode of Investment Insights by Opal. Thanks for tuning in to this episode. My name is Jay Coulter. Joining me as always, Austin Graff and Adam Mueller. If you'd like to ask us a question for one of our future podcasts, you can submit questions by sending an email to podcast@opalinvest.com or grab this QR code that you see on the screen right now, and maybe we'll answer one of your questions on a future episode. A quick recap on what happened last week in the markets. It was a slow week heading into the holiday weekend. Last week, the S&P was flat, while the NASDAQ printed record highs again, led by Apple and Nvidia that we'll talk about more on this episode. Speaking of Nvidia, they beat on both the top and bottom line while raising guidance and announcing an impressive 10-for-1 stock split. And at the box office over the holiday weekend, it looks like an epic failure for Hollywood. The Mad Max movie and Garfield both failed to bring people into the movie theaters. Austin, what are your thoughts on what we saw last week?
I think that maybe people didn't go to the theaters because they were watching Mueller on stage. I'm not really sure. But from the massive outperformance of tech, it's kind of continuation of what we've seen in the past, whether it be dividend increases or buybacks. We've got an environment where we have kind of a winner-take-all mentality in the market, and we continue to see a handful of names outperform handily. And that's what we saw with Nvidia kind of leading the market higher while everything else was left behind.
Adam, what's your take?
Yeah, I mean, thank God for a slow week. It's been a roller coaster, and with the market, at or near all-time highs, it makes sense that it would take a few days and just sort of hover. And last week really felt like it was just about Nvidia, and based on their results, they delivered, and the market is taking in that information.
Adam, any thoughts on Hollywood's dismal weekend?
Yeah, I was like the one person that went to a movie this weekend, and I saw the Mad Max documentary, which was great. I love a documentary that's 50 years before the events actually happened, but why anyone thought that a Garfield movie would do well is beyond me.
I got to tell you, I feel like inflation really is taking a hold of people who would go to movies on a holiday weekend like this. And you have to wonder if some of the prices that you have to pay in the movie theaters now maybe kept people away with the lack of a true blockbuster being in the theaters.
Look, I think there is a very real chance that inflation is playing a role in people not going to the movies as much. Regardless of all the different inflation metrics and the Fed's preferred inflation indicators, blah, blah, blah. The reality is that the average American has less purchasing power than they did a few years ago. And McDonald's is coming out with their $5 value meal again to try to get those folks back to the restaurant. And it wouldn't surprise me at all if movie theaters are going to have to do the same thing.
Yeah, I think it has more to do with the price of everything else than the price of the movie theater. I went and put gas in my car over the weekend, and here in Florida, you're paying anywhere between $4 and $5.50 a gallon. You're spending anywhere between $50 and $100 just to fill up the car. You're not necessarily thinking like, wow, why can I, or how can I go spend $20 or $30 at a movie theater to watch a movie? I think most of the economy is sitting here trying to find ways to reduce their overall spending, and the movies are an easy place to cut back.
Austin, your insight for this week is around the market's reaction to Nvidia's dividend. What's your take?
Nvidia's dividend is a joke. They increased the payout from 4 cents a quarter to 10 cents a quarter, which many are commenting is a 150% increase in the dividend. But it's a joke because they had to do that for the 10-to-1 stock split if they were to pay a penny a share per quarter going forward. After this dividend increase, the current dividend yield on Nvidia is 0.04%. That's a joke of a dividend yield. It's meaningless. The stock is not moving based on the dividend yield. It's moving based on the underlying fundamentals. They probably would have been better off just canceling the dividend and just moving forward with the stock split, as the dividend doesn't matter at this rate.
Adam, your insights this week are around Apple and China. What's your take?
Yeah, it's been very interesting this year to see Apple underperform, if not the market, then certainly its tech peers. And a lot of the weakness in the stocks has been has been attributed to a fear of weakness in China. Data comes out. Oh, Apple's not going to make as many iPhones because there's weakness in China, and so on and so forth. And then today, all of a sudden, out of nowhere, oh, Apple sales in China up 52% in April, and the stock is strong today. My point is, just be very careful of all the short term noise and all the analysts trying to do channel checks and come out with these short term data points. If you like the long term thesis and you know it's a great company, you really have to tune out that short term noise. What's going on with Apple in China? We'll find out when they report the next quarter. Until then, just try to not give in to the volatility of all the short term noise.
Austin, any thoughts on the Apple China dynamic?
Yeah, I think it's kind of interesting because you see that sales are up 52% after they engaged in some significant discounting and some partnerships with local retail peers. Historically, Apple's had this kind of premium perception that prevents them from needing to discount. And I think it shows when there is true competition, they will discount. And it might lead some to question that kind of premium placement of Apple and their iPhone product going forward without some new kind of technological launches on the horizon. So I think it's an interesting data point that people should watch, but I think the stock price reaction, as Adam indicated, is probably a bit overdone based on some short-term kind of noise in the numbers.
My insight for this week is something we've talked about in the past, but it continues to be a big issue for most Americans, and that's inflation. We've already touched on it some. Earlier this morning, Neil Kashkari was on CNBC, and I'm going to read some of the things he said. He said, I want to see many more months of positive inflation data before a rate cut. He said, I don't see a need to hurry and cut rates. He said the U.S. economy has remained remarkably resilient, and the Fed is in a good position because of a strong labor market. He said we need to wait and see and get more confidence on prices, and that inflation has moved sideways recently. You can see from the chart from the BLS that's on the screen right now, inflation with the government reported data has moved sideways, but I can tell you, when I go to the grocery store or I fill up my car, I'm just not seeing that sidewaysness. Adam, what are your thoughts around Neil's take on inflation today?
Yeah, and look, I don't want to be overly critical of Neil Kashkari because this is more probably the Fed, but it feels like, wow, how many different ways can you say we have to see more data? I feel like sometimes I don't have any insight into whether Neil was given his own thoughts or was sent out by the Fed to deliver the message, which they seem to do. But it's when they want to say we depend on data, they just send out Captain Obvious to say what everyone knows, which is that they're not going to cut rates anytime soon. The economy hasn't broken. Inflation is still well above their target. He slipped in the comment that, hey, maybe we'd even raise rates if things don't get better. And sure, of course, if inflation started to pick up again, they'd have to do something. It seems like the market has just become so greedy for these little Fed nuggets, which all they do is cause short-term volatility. And it seems like if the Fed should consider the less is more from a communication standpoint, and just do their job. Instead of constantly sending people out to say the same thing that everyone should already know.
Austin, any thoughts?
Yeah, I think you're seeing in some of the polling data around the presidential election that most of the kind of electorate is not happy with where prices are today. And it gets back to this kind of view that inflation is what matters, but it's actually prices that matter. And just because inflation has declined or it's not as high as it once was, that doesn't mean that prices are going down. And I think this is it's a huge kind of misperception in the inflationary dialogue. If prices just stay where they are into perpetuity and workers' wages don't go up, they're going to feel that grind of higher prices for a very long time, and they're going to feel much worse off. So you're going to get perceptions around purchasing and whatnot being relatively negative. So it's less about inflation and more about where current prices are. Without deflation getting prices back down to where they were in kind of 2020, 2019, I think you're going to see a lot of negative kind of perception out of consumers until they see their wages increase. And I think that that's kind of the paradox that government and the economy is currently in.
Look, every microeconomics 101 class on the final exam asks you to tell the difference between deflation and disinflation. And the reality is that inflation can slow down, but it doesn't mean it goes away. And there's a cumulative impact of inflation over the last few years. And if that cumulative impact is greater than wage increases, people have less disposable income. They have less purchasing power. And that's the situation that we're in. But at the same time, the economy hasn't broken yet.
This was the great part of like the transitory inflation argument in 2022, right? Where the Fed kept saying, "Oh, don't worry about it. It's transitory." Well, when it's up 9%, if it becomes transitory, it doesn't mean that prices go back down 7 or 8%. It means that prices are up 9% forever. Right?
And it could take years for people to claw that back in their wage increase.
Exactly. And that's what we're currently seeing, that even though inflation is down under 3%, right? Prices are growing less than 3%. Everyone wants to declare this victory. But then when consumers go to the supermarket or when they go to the gas station, they're like, wow, they get sticker shock. And they haven't worn off that sticker shock yet because their wages haven't increased subsequently with the inflation.
Let's close with our chart of the week. Viewers, listeners, if you would like us to break down a chart that you're interested in, please shoot it over to podcast@opalinvest.com and the team will break it down. This week's chart looks at stock splits and their ability to help beat the markets. Take a look at the chart on the screen. It looks at the price returns of stocks during different regimes where they had announced at least a 2-for-1 stock split. You can see during the 1980s, during falling inflation, stock companies that split their stock went up. Same with the strong economy of the 1990s, the bubbles bursting in the 2000s, and the liquidity-driven markets that we've had since 2010. Since the early 1980s, you see almost 100% outperformance from companies that announce stock splits. So the question is, do stock splits matter? Before I turn that question over to the team, take a look at this chart of an ETF. This is TOFR that was liquidated in 2017, and they were trying to capitalize on this thesis. For 3 years, they ran an equally weighted ETF that only invested in companies that had gone through at least a 2-for-1 stock split. Austin, what's your take on stock splits and investing?
Well, based on every finance class that I've ever been in, stock splits are meaningless for the actual share price. But based on what we see in markets where there's a lot of, let's say, retail money chasing trends, stock splits can be a significant driver. This just goes to show how markets aren't necessarily as efficient as many finance professors would like you to think. Emotion can drive stock prices in the short term, and this is what we're seeing in this construct. You see emotions driving stock prices as people get all excited about stock splits and lower stock prices.
Adam?
Yeah, I think this data is an excellent example of the concept of a spurious correlation, because I don't think the stock split in and of itself does anything, but it could be indicative of management confidence in their next few years. It can result in moving a share price into the right target zone to perhaps get added to an index like the Dow, which can bring in some buying power. There's the psychological effect of an investor with $1,000 to invest in the market doesn't want one share of Nvidia, but if they can buy 100, maybe they will. So those all point to things that could help a stock price. None of them about the fundamental performance of the company per se, but indicative of perhaps confidence, management's confidence in the company going forward. So it's an indicator. But in and of itself, it's completely meaningless.
You wonder if there isn't some factor research on this. Like, do companies that announce stock splits, do they have above average market earnings growth? And that leads them to the stock split. So it's kind of a cause and effect type situation.
Well, here's a great example. Buffett never split Berkshire stock, and it got up to 36,000, whatever the A shares are now. But when he needed a stock with a lower price to execute a transaction, he created the B shares, which is essentially a split in a way. because it allowed investors to own Berkshire at a more reasonable price, and indicated confidence in the company.
Well, almost any platform today offers fractional shares if investors actually want them. If they want a dollar cost average in, they don't have enough to actually buy a whole share. You can typically buy a fraction of a share, whether you're at Fidelity or Schwab or one of the other platforms. So I don't necessarily see there being a huge kind of benefit to the split, other than there might be some projecting from management saying, hey, we think there's great opportunity ahead, so we want to split the shares. Or it could be an indication that it could be a momentum play, to speak to the factor argument, Jay, because if a stock is up so much that it needs to be split, it indicates that it's been moving positively for some time. So the split might just be building on some of that momentum. I'm not really sure. It'd be interesting to see what some of the academics would say about this research. I would say whatever they do say, though, take it with a grain of salt, because they're likely solving for some outcome that supports their argument.
And those fractional shares are relatively new, right? Those that only happened after stock prices got rid of the fractions and went to sort of a decimal, sort of more precise pricing mechanism. So it'd be very interesting to see this split data over the next 10 years and to see if that outperformance is as strong when people can, in their Robinhood account, they can buy 1/10,000th of a Berkshire share or something, or point.
Yeah, remember that Buffett was essentially forced into creating the B shares because there were, people who were out there trying to profit off of the fact that he had a $18,000 share price, and he didn't like that. So he created, instead of splitting it, because he's kind of known so well for refusing to split the shares, he created a B share class that essentially looks and acts the same but doesn't have the same voting power as the A shares. And I mean, I guess the thesis behind why he doesn't want to split the shares is because he feels people that have enough money and are long-term invested shouldn't necessarily care what the price is. It also kind of drives home his point that it's less about what the stock is doing and more about what the business is doing, which we agree with. However, we don't all have the luxury of having a Berkshire Hathaway to manage. So it's kind of speaking out of both sides of the mouth there.
And that's actually a great point for the individual investor. Because I don't know about you, Austin, but the number of times I've had someone come up to me and say, hey, I'm thinking of buying this stock, ABC. The price was 12 and now it's 5. So it must be cheap. And I have to explain to them that doesn't mean that. That just means the price has come down. We have no idea what's gone on with earnings or anything else. The stock price is not in and of itself an indication of the value of the company. So be careful. But a lot of the average person out there sees that and perhaps gets excited on a stock split because now it's 20 and it used to be 100. What a great time to get in. And in fact, nothing has changed.
Well, what percentage of the people, Adam, that actually invest or speculate in the stock market do you think actually know how to value a company? Like go into Excel and actually figure out how to determine what the value of the underlying company is, rather than just looking at a chart and trying to understand or trying to guess where the stock price is going to go.
Yeah, no, that's a great point. I think very few.
And it also makes me think about the late 90s when America Online decided to start splitting stocks on a fairly regular basis. And then there was FOMO, because what other companies then started coming out and announcing stock splits to help keep driving up those stock prices? Could Nvidia be leading the charge on this? Are we going to see more of it going forward? That probably has no rational reason to do it, Austin, to your point. But are they going to need to do it to keep up?
Listen, I think that the rational reason at this point would be to get included in the Dow, if anyone still follows the Dow, because there are a number of tech shares that have been running for a long time that are in the kind of high hundreds to low thousands that likely won't get included in the Dow because it's price weighted if they don't cut or if they don't split the shares. That being said, this is an argument that's kind of probably been around since the beginning of the stock market, and it probably gets a lot of play between the kind of the people who follow technicals and charts versus the people that follow underlying fundamentals, because this is probably the biggest battleground between the two, because the pure fundamentalist doesn't care about the stock price. They only care about the market cap and what the underlying fundamentals are doing. And the pure chartist doesn't care about the fundamentals. They just want to see what that squiggly line is telling them on the stock price.
Gentlemen, that was a great show. Viewers and listeners, if you'd like to submit a question, send an email to podcast@opalinvest.com or use the QR code on your screen. Send your questions or chart ideas. Thanks for listening to this episode.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital, LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.